Now in the yellow circles, we have time periods in which the market stops, and it falls into those minor support and resistance channels that we discussed earlier. Now when we look at the corresponding lines, we'll start off with the first circle underneath, we see that when there was a buy signal, it occurred as the accumulation line started reaching higher and higher points along its trending line, and then the price started to move up. Now in the first circle, it looks like the market's trending up anyway, so it's a given. But let's look at the second ellipse there, and we see that the market has basically stopped. It's found a point where we believe the buyers are willing to pay, and we believe the sellers are willing to sell. But strangely enough, the accumulation line continues to move up. So that shows that at that consolidation point, the hedgers were still interested in driving the market higher. For whatever case, either they felt that there was a market shortage, or they felt that they needed to continue to go long the market because of demand, who knows. But the accumulation line continues in its upward momentum. And sure enough, it springs right out of that trading range, out of that channel, and moves to the next level, which again, it finds a plateau. When it finds that plateau, we see the accumulation distribution line continue upwards. And in this instance, it again shoots straight up for 3 months at a time, from November to beginning of January. Now if we look at the tail end of this, and I didn't really show it on this chart, but if we look at the tail end of this, the distribution line starts to fail. There are no new higher highs. It starts to go to more lows, or less higher highs. And correspondingly, the gold contract starts to lose momentum as well. So it was definitely a distribution scenario. So when you look at this accumulation signals, you have to realize that even though the price may look like there's nothing happening, underlying something's going on, and the accumulation distribution line definitely shows that. Let's look at a distribution chart, and this is sugar. Right here we have about 5 areas, 5 circles represent 5 areas in which the sell signals are definitely prominent. And they are prominent at different times where you expect things to continue to move up. In the first time we look at, we see sugar hitting an all-time high, an all-time new high. And it has the opportunity to either reach another high or at least mellow out and stay where it is. But as the sugar is reaching a new price high, the distribution sets in, and we see that there are no newer highs in the accumulation distribution line. There's actually distribution going on. And so immediately we see a sell signal, and sure enough, the market starts moving down for 2 months and then lulls out. And then the second group, we see maybe the market's starting to pick up, but immediately we look at the distribution line and it's not reaching newer highs. The highs are starting to decrease successively, and sure enough, the market pushes down and reaches another low. We see on the third circle the same thing, same scenario happening. The fourth circle, we see the same scenario happening, all the way to the end, in which sugar reaches an absolute new low completely. And so each one of those opportunities was an opportunity to add a contract. And as I said before, the markets tend to favor shorts, and this is a prime example of the shorts winning out in this scenario. So no matter how many times there was rallies into the market, the shorts definitely took the cake here. And it was a long-term trade. It went from February of 2003 all the way to January of 2004. A very long-term trade. And with the leverage available to futures, if you'd only traded that for the year, you would have definitely come out ahead. Now we'll discuss open interest. Many of you who are familiar with any type of options, whether they're stock options or futures options, are very familiar with how open interest works. They represent the total number of derivative contracts traded that have not yet been liquidated, either by an offsetting transaction or by delivery. So we'll briefly run through what open interest is for those people who may not be familiar with options trading or who may not be familiar with how open interest operates in the futures market. The example runs like this. Mr. A, a new market opens for nails. A new futures contract opens for nails. And Mr. A believes that nails are going through the roof. So he sells, he believes the nails are going to go lower through the floor, basically. And so he sells one futures contract. And Mr. B believes the absolute opposite. He believes that nails are going higher, so he buys one futures contract. That creates 1 point of open interest. We have one long and one short. Then we see that this new market is attracting more people to it. And so we see Mr. C buys a contract from Mr. D. Once again, 2 brand new longs, and 1 brand new long, 1 brand new short, 2 new contracts, which creates 2 units of open interest. Then we see that Mr. E buys a futures contract from Mr. B, who's released from his position, being replaced by Mr. E, and open interest stays flat because there's still one old position and 1 new position. No new positions have been created. And then lastly, we see that Mr. C and Mr. D close out their long and short contracts completely, and open interest decreases by 1. This is a very subtle way to see the accumulation distribution going on with the hedging community when it comes to futures. Open interest is very important and definitely should be part of the indicators that you use to determine your trading. Open interest breaks down into just basically 3 items. When open interest increases, when there are new longs and a new short. Open interest decreases when old long sells to an old short. And open interest does not change when old longs or old short are simply replaced by a new long or a new short. Flat market. And the way to trade open interest is in 4 ways. You match open interest up with the price. When the first one is when the price is up and the open interest is up, you have a technically strong market. That means that there is momentum, more contracts are coming in to continue to drive the price up. In the second way, when you see prices up but open interest is down, even if the prices look like they'll continue to go straight through the roof, this is a technically weak market and you should look for opportunities to short into it using some of the other indicators that we discussed. And then third, when you see that the price is down and the open interest is down, you usually see a kind of a shakeout period, something that happens when we talked about the notice days. So something may happen on the last notice day or close to the last trading day. You see price being down and open interest being down only because everyone's trying to figure out what's going to happen or where they're going to go, whether they're going to push to the next contract or just a little bit of a shakeout. So usually as longs are exiting the market or or the bulls are exiting the market at a kind of a strange time. So usually that's where you see flat markets. And then the fourth, which is a very strong indicator, is when you see the price is down but open interest is up. So that means there are more shorts driving this market, and it's a very strong bearish indicator. Let's look at a few charts representing these ideas. This is a chart of decreasing open interest. This is live cattle, March 2004. And at the time, towards the end of where the yellow circles are, we see a rebounding back from the mad cow scare. But this is only in the price. This is a technically weak rebound because open interest is still down. It gives us the idea that people started sitting on the sidelines because they weren't sure of how far the market was going and whether it was going to continue to move up or continue to move down. And so this rally upward is actually what you consider a false rally. But at the same time, it's still an opportunity to profit. So you can't just take this indicator all by itself. But it does show you that it may not be a long opportunity to profit. It's something's happening behind the scenes. And wait for more information if you're going to go short this market or go long this market any further. So it's very much a sideline indicator. In this decreasing open interest, we have gold. Gold did a tremendous run-up from July of last year to the beginning of this year. And in fact, it went so high, it hit new highs that it hadn't reached since 1996. A new high of 430 was the absolute. But we see here that the price is starting to push down on gold, and open interest is down as well. So you see a little bit of the longs starting to push off some of their trading. They don't want to be caught holding the bag in case the market tanks all the way. So it's a little bit of a relief, but we don't know how much further it can go down.